Hi, everyone. Welcome to our quarterly Diamond Trends webinar. My name is Avi Krawitz. I'm the Senior Analyst at Rapaport. And thank you for joining us. Thank you for giving your time. I always feel that that we need to have these conversations about the market, and it helps me to understand what's going on, hearing from you and sharing my thoughts with you. It helps me refine some of my thoughts about the market, and so I appreciate the opportunity. The diamond industry is now in its peaks, or the jewelry industry and diamond industry is now in its peak selling season, and so it's such an opportune time and an important time for the market, and at the same time that holiday season injects some optimism and excitement about the market. There is also the other aspect of uncertainty that's been sort of a theme in the last few months, or for most of 2022, really. And so the title of our talk is dealing with uncertainty and trying to understand what is happening in the market. And so the goals of our webinar today is to look at diamond prices, to try and understand what's causing the decline in prices that we've seen for the last few months. We want to, in so doing, we're going to review the supply-demand dynamics of the market as we head towards the end of the year. And importantly, we want to understand the state of retail at the moment, as the focus is really on retail at this time of year. And it seems that we are getting some different sentiment, or reading some different sentiment from the different segments of the market. You know, when you compare the sentiment coming out of retail versus the polished trading scene and the rough markets, there's a different energy coming from each of them, and so we will try and understand why that difference is in place. And then I will also spend some time at the end of the webinar just identifying four trends or themes that are sort of dominating our conversation in our editorial meetings and in our editorial mindset, that we think that the industry should consider and is considering. Is very central to how the industry is shaping up, and so I'm going to spend some time tackling those. And then I'm not going to make any predictions about the holiday season or 2023, but within the presentation, I think one should have in mind that sort of focus. You know, what does this mean for the market moving forward? So I hope to, in so doing, provide some insight to what we can expect. So let's get started. The uncertainty is twofold. I think there's the slowdown in China that's clearly affecting the market, and I think when we compare diamond trading and diamond demand to previous years, that's where we're seeing the biggest decline is in the demand coming out of the Far East, and so that's for a number of reasons. Economic reasons. Certainly COVID is continuing to have an impact on the industry in China, as restrictions are still in place that limits travel to and from China, which means that any business taking place in China, you still have to go through quarantine, etc. And there's no, and we're not seeing those Chinese tourists that have been so influential in boosting sales in important centers such as New York, Hong Kong, London, etc. So that's not happening at the moment, and that's having an impact on the industry. Demand has become localized in China, and there's also some economic uncertainty there, which is affecting that local demand. Anyway, the other aspect is in the US and Europe, and there we all are quite aware of inflationary concerns. It's happening inflation is affecting everyone across the globe. and certainly in the United States, it's still above 8%. I think the consumer price index is sort of leveled out at those levels, and that's affecting sentiment. It's affecting consumer confidence, discretionary spending. The consumer disposable income is down. If things are more expensive, then people have less to spend, and with their salaries at the end of the day. And so all these things, higher interest rates, etc., stock market volatility affects wealth sentiment, and so all these messages and factors that we hear about on a daily basis are affecting the market, at least from a sentiment point of view. And so the question is, to what extent will this uncertainty impact the retail sales, jewelry retail sales during the holiday season and moving forward, and also sentiment? And I separate those two aspects: retail sales on the ground and sentiment within the market. And we'll touch on that a bit later. But basically, in terms of the market flow, there's such a stark difference between 2021, when the market was good and in the green, and 2022, where things have slowed down and been, I wouldn't say they're in the red, but it's maybe red represents a bit more caution than the green. So in 2021, we saw strong jewelry sales, and that stimulated polished demand, which lifted polished prices and margins in the midstream, and that boosted rough buying and manufacturing. And so you had this trickle-down effect that was driven by higher demand, and that's the way the market should function. And it was a good year across the board for the industry. In 2022, we've seen a different story. Jewelry sales have been weaker, particularly, as I mentioned, in China, and also in the United States. We're not, in the second half of this year, at least, we're not seeing the same growth as we saw previously, and that influences caution in the polished market. We've seen, as we're all well aware, that polished prices have declined for the last 8 to 9 months consistently, and that affects that squeezes margins in the manufacturing sector and brings about a slowdown in rough buying and manufacturing, and that we have seen. But and so just to see it, as we always do, explore the RAPI index and the performance of the RAPI index, which represents our tracking of diamond prices. We see that the RAPI index has been on a decline for a number of months now, at least since March, which March was an important month in the world. Obviously, there was the breakout of the Russia-Ukraine war, and there was also the beginning of the sort of economic uncertainty became more real in the United States, at least, and which sort of triggered the higher interest rates, and we saw the inflation playing out. So the 1 carat is, for the year to date, that's till November 15. 1 carats are down 8.2% in the RAPI index. The similar amounts for the 30 pointers and half carats, and the 3 carats have performed a bit better and are down just by 0.5%. When we look at it on a quarterly basis, as I like to do, we see the consistent it's basically 3 quarters now of declines, and we're halfway through the fourth quarter, sorry. So we had a strong first quarter in the RAPI index for 1 carat, is up 13.5%, but then pretty sharp declines, and that's shown in the context of the positive trend in 2021. that in fact, since the second quarter of 2020, we had consistent increases in the RAPI index, and so we're seeing now a reverse of that trend, and it's kind of similar to what happened in 2000 in the recovery of 2000 and 2009 or 8 financial crisis. We had this sharp drop during the financial meltdown, and then the sharp increase, which was also driven not only by a recovery in the United States, but very much so by an expansion in China at the time. This time we don't have that. It's purely a recovery play from the COVID decline, which was less sharp, let's say, in 2020. But we've had this perpetual decline in prices since 2011, and so that increase in recovery was a nice bounce back. But now we are seeing in 2022 a sharp sort of decline, and the question will be is if we can reverse that, and how I don't expect that we'll have this prolonged sort of decline as we did before, but it's worth noting that that prices are back at 2008 levels. If you look at it, the RAPI index is flat compared to the beginning of 2008. So it's kind of interesting. So what's causing this decline? We know that price is a function of supply and demand, and so when supply increases and demand remains stable or decreases, then prices decline. And the opposite is true. If supply comes down, it would support polished prices. And then on the demand side, more importantly, if demand increases and supply is stable, it should influence an increase in prices as well. So if demand comes down, then it should influence, put some pressure on prices. And so we all know that from Economics 101. But how is it playing out in the industry? And so I'm going to look at supply first. That when we look at the inventory that's on RapNet at the moment, it's at historic highs still, and so there seems to be a lot of polished inventory on the market, and that's even in the context of the Russian supply crisis. That and we'll touch on that in the coming slides, but it's worth noting that in 2018, 2019, the narrative was very much that there's a lot of inventory on the market, that there's a backlog of goods, and that was influencing a decline in polished prices during those years. Today, the inventory on RapNet is higher than it was pre-COVID, and so that certainly indicates to me that there is, from the supply side, there has been an increase in supply that might be influencing the downtrend that we're seeing in polished prices in recent months. And we see that play out in that RAPI category. This is for 1 carat again. That since the beginning of the year, the black line represents the RAPI index. And we see in the orange line the rise in inventory that's available on RapNet, and so that's for that specific category of goods. It's 1 carat is D to H color and IF to VS2 clarity. And so as we see here that inventory declined at the beginning of the year. When the market was good pre-Russia crisis and pre-economic caution, or when the economic caution was still sort of brewing, that supported the level of polished prices, and there was a steady increase going on. As inventory started to rise and continued to rise, so it put pressure on polished prices, and we're still seeing that today. And so it begs the question, why is there so much inventory on the market when when there are sanctions on Russian rough, and it seems that, or anecdotally at least, there's very little data that's coming out of Russia at the moment, but there's less rough from Alrosa that's being sold to the market. The initial prediction was that there would be shortages on the market because Alrosa accounts for such a large portion of rough production in the world. As you see from this pie chart, it's Alrosa and De Beers are around the same. For 2021, this is at around 27% of global production. There's another Russian producer here, Grib Diamonds, and the market is split between the rest. Indiama, the Angolan company, has 8%, Rio Tinto 5%, etc. But the point is about Alrosa. Why has the limitations on Alrosa not affected polished inventory that's out there? I hope you understand the question. When we look at the data that's available, there seems to be an inventory overhang that the market is working off, and that comes from 2021. That in 2021 there was a bullish market, because the industry had performed so well, and also in the first quarter of 2022 there was bullish rough buying, and so the rough market didn't predict that there would be a slowdown as there has been later on in the year. And we see that rough buying from the fourth quarter of 2020, really, there's been this spike in rough imports to India. India is a good indicator of manufacturing levels because of its dominance in that segment, and so the rough imports to India spiked as we expected them to after COVID, and maintained a fairly high level in terms of the goods that were coming into that manufacturing center. Sorry. We see through 2021 that the orange bar chart represents the volume of goods, and the blue is the value of those goods, and we see they remained pretty high. And also through the first quarter of 2022. And so those goods were then being manufactured into and converted to polished in the second quarter and third quarter when the market had slowed. And so so they bought in an optimistic market, but they manufactured there was manufacturing of those goods in a slowdown. And so I think that has contributed to the buildup of inventory that we're seeing in the polished market. Interestingly, in the third quarter, there was another return to rough buying, it seems, and there was there seemed to be, and maybe it's a seasonal thing, I'm not sure. It's a little down from 2000. It's around the same as 2019, which is maybe a good indication of the sentiment in the market. So at the same time, as I mentioned, we kind of see the slowdown compared to 2021 in India's polished exports. They're importing the rough in order to export the polished, manufacture and export the polished, and we see that we see that slowdown compared to last year. The export numbers are well below 2021 levels. Interestingly, the value of goods exported from India is still high and in line with 2021. And given the price declines that we've seen this year, that would indicate that there's a shift to a higher quality good, high quality diamonds that are being exported, or higher value goods, larger stones, etc. So, and I would say that is natural to happen in a time of uncertainty. There's generally a focus on higher margin diamonds in the manufacturing sector. So that's from a supply point of view, and it's the only theory I have really. If any of you have any other ideas that you want to share, please by all means do so. And but to me, it seems that polished inventory is up, and one of the factors that's influencing that is that there was a spike in rough supply in 2021 and first quarter of 22, and that's influenced the polish to come to market at a time when demand is down, and demand is the other side of the equation. And so we have to look at, and probably the more important side of the equation, if there's strong demand, then you want higher supply. It doesn't matter that there's you expect that supply would match demand. But demand seems to be down. And inventory, as I mentioned, inventory rises due to higher supply, as we've seen, but also due because sales are lower, and suppliers are left with the goods that they can't sell. And so, as I mentioned earlier, the slowdown in China amid the continued COVID-related restrictions has had an effect on global demand, in that the midstream is supplying less to that market, and it's an important market for the industry. In the United States, and I would say also in Europe, retail has been okay. Even if it's down from 21, it's still better from previous years, and it's a observation that many of my colleagues have made. My friend Edan Golan wrote an article suggesting, as he tracks the retail sales month on month, showing a decline compared to last year, made the point that we should really be looking at 2019 as a benchmark comparison, because 2020 was an unusual year due to COVID, and so the declines were sharp. 2021 was a recovery year, but it was also an anomaly year in terms of how good the market was across the board, also in China, by the way. And as I mentioned, had a trickle-down effect. So we should be looking at 2019 as a comparison, and as Edan points out, and as many of the parameters that we look at suggest, the market is still above those levels and pre-COVID levels, and that's very encouraging for the industry. But we've got to also look at the context that we're playing with at the moment, and that's what we're trying to do here now. Another aspect of demand is that the brands are doing well, and their sales have been fairly good. Brilliant Earth had a brilliant quarter in the third quarter, but they lowered their expectations for the fourth quarter. And so we are seeing that from a number of retailers, that they've had decent sales this year, but they're tempering their expectations, and they're expressing more uncertainty about the economic outlook than they did before. We see that in our news feed. These stories, which are not so easy to read, but it's taken from our new website, which, if you haven't noticed, Rapaport, we redesigned our website. It's looking great. It's much more easy to use and reader friendly. And the URL now is rapaport.com, not diamonds.net. And so it's a big change for us, and we're very excited about it, and we'd love to hear your feedback on the new design as well. But it's a side point, excuse the marketing plug, but we're very proud of it. But some of the headlines that we've run in the last few weeks, as I mentioned, Brilliant Earth warns of caution among consumers. Richmond, which is the higher end company, it has Cartier Van Cleef in its stable, saw a jump in its sales. Pandora being sort of maintaining its forecast, but also acknowledging that there are concerns about a recession. In India, Titan Company, which is the biggest branded jeweler in India, had a very strong quarter in the third quarter, preceding Diwali, but also indicating that the season would be good because people bought ahead of Diwali as well. And then we are seeing some pretty optimistic predictions about the holiday season from analysts and researchers. The NRF, the National Retail Federation, whose agenda is to promote retail in the United States. So take my comments in that context, but they're expecting 6 to 8% rise in sales across the board in November, December. Deloitte predicted 4 to 6%, etc. So despite the caution and uncertainty, there is still some optimism and sort of confidence in the retail sector, and there definitely are sales as we saw in October. It's important to understand why we focus so strongly on the United States, and it's because the United States is the largest market for diamond jewelry by far. It accounts for about 54% of global diamond jewelry sales. These numbers are according to De Beers. De Beers put out their 2021 numbers in their recent insight report, and it's excellent reading and always insightful data as well. But they see the United States as 54% stakeholder in the diamond jewelry market. China being the second biggest market, and with 11%, then followed by India, Japan, and the Gulf, and the rest of the world, which include Europe. And so America matters in a very big way for the diamond industry, as does China. When we look at global diamond jewelry demand, and this is again based on the De Beers Insight Report, except for 2022, that's just our sort of guesstimate, I would say, that we see from the numbers what a strong year 2021 was, and as I said, the trickle down effect it had on the rest of the supply chain, and De Beers numbers show that as well. There was growth across the board. When we're looking at 2022, the second half of the year seems to be cautious, and that's where we're seeing the declines compared to last year. But the first quarter at least was pretty robust, and so the estimates are, we can expect, and take this with a grain of salt, but we can expect maybe, if it's flat growth compared to last year, if it's slightly down, again, if it's slightly down and above 2019, then we're doing okay. It sets a good platform and basis from which to grow moving forward. If 2023 shows another decline, I would be more concerned. So yeah, why the slowdown? Retail is doing well, but they're expecting more uncertainty than before, and so that affects how jewelers buy. So if they're making sales at jewelry, and it's they're doing okay, if the market's flat compared to last year, let's say, then why isn't that trickle down effect? And as I mentioned earlier, I want to distinguish between retail sales and the sentiment that's coming out of the retail sector, and the sentiment that's coming out of the industry, the trade as well. And I think we are seeing a bit of a difference in that. As we saw from the news reports, that sales have been okay in the third quarter, but the outlook is more cautious. And so that affects how jewelers are buying in the diamond market. That affects the inventory that they want to hold, and how they want to, how much inventory they want to hold, and how much they're going to go to the market to buy. And so, in general, as a general principle, even before this current slowdown and coming out of COVID, there was a more careful inventory management among jewelers. And that's for a number of reasons. Firstly, they always want to limit their inventory risk, their risk of holding inventory. If they're holding too much inventory and there's a crisis and a downturn, then they're left with inventory that they can't sell, and it's and it affects their bottom line. The second aspect that I've mentioned before is that omnichannel is impacting inventory levels, and so retail inventory levels. And so if they are selling more online, that means the online platform is a global store for them in multiple, reaching multiple locations. And so they don't need to hold that inventory in each of those multiple locations that they would have to for a physical store. And so if they're selling more online, there is a central sort of inventory bank, let's call it, and they can draw from that as the orders come in, or they can make their own orders from their suppliers as the orders come in. And so they don't need to hold that inventory as much as before. That means that that retailers are demanding faster delivery from their suppliers, and that's pushing the supply chain to be more efficient. And that's an important trend that we're keeping an eye on at Rapaport, and how it affects the greater diamond market dynamic. The more goods on memo, we're always talking about more goods on memo. Certainly in times of uncertainty, retailers, again, because they don't want to own the inventory, memo is an avenue with which they can have access to goods that they only pay for at a later date. It's an interesting exercise, and I'm trying to wrap my head around it. That higher interest rates raise the cost of memo for suppliers, and so it might not be a major influencer for the market, but it's something to think about. That how are memo houses and how are suppliers of polish responding to higher interest rates, which basically affects their opportunity cost. If it's more costly for them to own inventory, which they need to supply memo, than to just keep the money in the bank, and they can earn more from the bank, then are they going to do it? And then, or does it increase their terms? Do they change their terms in their memo agreements? That's probably what we would expect to happen. As I mentioned, there's different sentiment coming out of different segments of the market, and in particular, I want to touch on manufacturers versus dealers, because we are seeing greater caution in India than we have in the United States. Certainly, in the run-up to Diwali, there was a difference in way the market was playing out in those two important centers. And it's because they have different roles in the market. India is a manufacturing center. Manufacturers need to buy rough, and they need to generate cash in order to buy rough, and so they sell polished in order to keep the wheels turning. That enables them to replenish goods that they've sold with the rough in manufacturing that it enables them to buy rough because they need to keep their factories turning. And so for manufacturers, their biggest challenge is profit, because the rough and polished markets often sort of sidetrack in different directions in terms of their pricing dynamics, and in terms of this cycle that they run along. Dealers, on the other hand, they don't buy rough; they buy and sell polished, and so they need to turn over. Their biggest challenge is to turn over goods. They have greater leeway to hold goods than manufacturers might, because they don't have that same liquidity challenge that manufacturers might in terms of being contracted in many cases to buy rough, that some of the site holders, for example, do face. And so certainly in the run-up to Diwali, there was this sort of sense that the manufacturing sector was raising discounts in order to reduce inventory, which as we saw has increased, and to generate cash in order to go into the Diwali break with some liquidity. But at the same time, those buyers lacked the urgency to buy, and they were cautious to buy as polished prices were declining. In a downward trending market, buyers are hesitant to buy because they expect that prices might go down further tomorrow. And so there was that sort of stalemate and a decline in buying activity from during that third quarter period and moving into October, before Diwali. I would say, and I use the word panic here, but it may be a little dramatic, but that sense that you need to raise liquidity and reduce prices to push the sale, it seems to have calmed since Diwali has passed. But buyers are still picky, and the market is very selective. They're buying things which are easier to sell, and so as often happens in times of uncertainty, demand has narrowed to a more select range of diamonds. I just put this here because it's always important. As I mentioned, the United States is an important market in terms of the dealer market, and it also illustrates a bit of what's happening in terms of demand. The red is the volume of goods in carats, and the blue line is the value of those goods. And so there's a bit of a lag in the US data. The latest we have is from August, and we see that July, August, which should be, we see in 2021 that they were, August at least was an important month. If you think about it, that's when retailers should be buying up inventory to prepare their collections for the holiday season. And we didn't see that spike in 2022. The volume and the value of goods has come down in that month, but it's only 1 month. So we would need to see September data as well in October to make a definitive call on that. I'm just looking at the month though. In the previous slide, we presented India's quarterly data, and I think it's worth looking at the most recent months that are out there. October saw there's been a fairly consistent level of the quantity of diamonds that have come out of India in the second and third quarters, and in October. And as I mentioned, you can see the level of the drop-off compared to 2021 on a monthly basis, and so it's quite significant. And that again reflects that demand has slowed in 2022 for all the reasons that we mentioned. But I think more interesting in October has been the drop-off in rough buying, or the rough imports to India in October in particular. As you can see, except for April of this year, which was when that was the heart of the Russia crisis. It's a pretty low number and significantly below last year's rough imports to India. So again, that's another indication of the supply increase that we've seen of polished inventory. People are holding a lot of goods, and so that would naturally affect their thinking about manufacturing more and buying more rough. And sorry, just one other thing on the rough market. It's we're seeing a similar message from De Beers, at least, that our understanding was that they were a bit more flexible in their last site. They allowed site holders to to sell back to De Beers 20%. Usually that's it's 10% level, and so it again indicates that that the demand for rough at the moment, the rough market is prepared to sort of lay low and let that polished inventory be reduced a bit during this peak selling season that we're in now. And so that's all the market related sort of supply demand price dynamics that is taking shape at the moment. I hope I was clear in my thinking or an analysis of the market dynamic. I did want to spend some time looking at some key trends and themes that are shaping our editorial thinking at the moment, and that's shaping the industry conversation. And I think it's very worthwhile that companies, businesses across the supply chain are aware of these themes, even if you don't agree with my take on them. And those are the lab-grown industry, and in no particular order. I put them in order because I think it tells a story in how how I hope to frame it. But there's a lab-grown market, there's the sustainability push that we're seeing from brands, there's the increase in branding and marketing activity that's taking place in the industry, and then there's the De Beers Botswana negotiations that are going on in the relationship between those two parties, which are generating a lot of interest in the trade press, at least. And so I'm just going to spend a quick few minutes on each one. The beginning with the lab-grown industry, and I generally have shied away from going into the lab-grown dynamic on these webinars, because I think our job is to focus on the natural diamond industry and understand what's happening in the natural diamond industry, because firstly, it's a much bigger and more important market. Secondly, we love natural diamonds. We're still kind of maybe skeptical about lab grown, and from a personal point of view, at least, admitting my bias. And thirdly, I don't believe that the lab grown industry will long term have a major impact on the natural market. I think they will segment into separate markets, or I think I'm hoping they will. But I think that at this stage, at this time, we need to recognize certain trends in the lab grown that is affecting the natural diamond space. And the first is that all our predictions about the lab grown market have kind of, or not all of them, the pricing predictions are coming true. But in terms of the segment of the market that is growing most, we all predicted that it would affect the smaller goods, and that has not taken effect as we thought it would. In fact, it's the jewelry retailers are more interested in larger lab-grown diamonds, and that's where we're seeing the major growth. And so that's a point worth noting and highlighting. And we're seeing that in our news flow. Just this last month, we saw that Blue Nile announced an expansion of its lab-grown collections or range on offer to bigger goods, and kind of indicating that it's a bridal offering. Lab-grown Pandora, we know, has been very invested in lab-grown and chose to launch in the United States for the holiday season. And again, that's more of a fashion play, but they're not going to be looking at melee for their offering. And then Zale was the other standout big company that launched a bridal collection in the last few weeks, featuring 1 to 3 carat lab-grown stones. And so these are things worth noting, and again, just sort of reiterating the fact that it's not the small stones which is gaining market share or trying to take market share. It's on the larger sort of single stone goods that we should be aware of. We held a very interesting discussion, a webinar a few months ago about lab grown, and sort of what the title was, what's next for lab grown, and I wrote it up for our October research report. I highly recommend that everyone watch that if you're interested in this space. But one of the takeaways for me was that the lab grown producers, the growers, face a similar challenge to the natural diamond industry, and that is to get consistent supply that is required by retailers. And it shouldn't be a surprise, because that's how the jewelry industry works. But there was this perception by myself as well that that you could just sort of flip a switch and produce as many diamonds as possible. But my takeaway from the discussion was that the lab-grown space is nuanced as well, and in order to get that consistent supply, and it may vary from retailer to retailer, it's not so easy, and it requires a certain quality of lab-grown diamond as well, and that's where the brands or those bigger companies like Blue Nile, Pandora, and Zale come into it, that they are requiring a certain quality, and so the shortage is in the technological ability to provide that quality of diamonds, and that's where the consistency comes in. It's not a matter of supply per se. It's a matter of a shortage of those scientists who are able to produce, and the R&D that goes into producing those quality lab-grown diamonds that many of the jewelry retailers are demanding. And we've seen that there's been a shift in the sort of sweet spot of where the lab-grown diamond industry is operating, whereas before it used to be on the lower colors. The sweet spot today is on E to G color goods, and that was a point that was made by one of the panelists in the webinar, and that's again a technological play, that as technology has improved, it's enabled the growers to provide a better quality and nicer lab-grown diamond. And the final point that came out of, not necessarily came out of the webinar, but it came out of the discussions that I had within the trade after the webinar, and it came up in a podcast that I did with Kieran Hodgson, who's an analyst at Panmure Gordon. He covers the industry very closely, and he made the point that that it's the sales pitch that should be the retail sales pitch that is the biggest area of concern for the industry. And from that, he made the point that it's that retailers are selling lab grown as a more ethical product, as responsibly sourced, that with the assurance that it's not a conflict diamond, etc. And that does the natural diamond and the jewelry industry as a whole a disservice, and I couldn't agree with him more. And that's something that the trade that is invested in natural diamonds needs to work with those jewelers who may not be as immersed in these issues. They need to work with them very, very closely, and I think it's upon all of us to change that perception. But the other aspect of the retail pitch is my reading of it, and you can disagree with me or argue with me, but from my understanding, what is happening is that it's not necessarily consumer demand that is, hear about a lab-grown diamond on the street and coming in and asking for one. The consumer at the end of the day is coming into the jewelry store with a budget. The retailer, the jeweler, is looking at that budget and giving them a choice of what they want, and selling them, saying to them, you can have a 1 carat, for the same price, natural diamond, but for the same price, I can offer you a 2 or 3 carat lab grown diamond, and then going into that other, or the proposed or supposed benefits of a lab grown diamond. And so it's it's also a choice of the retailer on what they want to sell and the message that they want to give. And at the end of the day, the buck stops with them. And so as an industry, we need to, I think, work with them to maybe give a more honest message, and also to work towards what's best for the natural diamond industry as a whole. Okay, so as a segue from that messaging, there has been the other theme that I want to highlight is that of sustainability and the ESG considerations that many in the industry, the bigger companies in the industry, are pushing, and and it's driving the industry in a certain direction, which is very positive. And the industry's done a lot to improve its ESG credentials. ESG stands for environment, social, and governance policy, let's say, that a company can adopt. What are we doing to improve the environment, or not damage the environment, or on various levels? What is our contribution to social upliftment, and governance being those, in terms of our corporate structures, and are we being straight shooters in how we conduct our business, or at least that's how I read it. And so sustainability has emerged as a central theme for the industry. And when we've heard these sort of buzzwords in the last number of years: blockchain, traceability, ethical sourcing, social responsibility, etc. Those are not in isolation. Those are not being spoken about in isolation. They're all under the umbrella of driving the industry towards a more sustainability practice. And so that issue of it's not by chance that sustainability is being pushed by the brands to satisfy, because it's a very much a conversation being had in society today, certainly. And consumers, there's an assumption that consumers have this desire for ethical product. I think it's probably more than an assumption that they do desire a more ethical product. But it's more than that. It's that a brand needs to have a solid ESG credentials to underscore its message, and even if it's just to avoid a backlash, because if the consumer isn't asking for the ethical product, if a company or brand is found to be unethical or have unethical sourcing practices, that there will be a backlash on that. And finally, it just enhances the story. It makes the story of that the diamond industry can tell that much more compelling. And I think we're seeing that today with many of the brands. Certainly De Beers has been a big advocate. I spoke with Bruce Cleaver. We did an interview together as he prepares to step down from his role as CEO of De Beers. And he mentioned that he brought sustainability into his role and recognized its importance, but he maybe underestimated just how important it would be over the 6 years that he's been in that job. And we've seen it in our coverage as well, that it's really gaining more importance. And so companies within the supply chain, not a brand, if you're supplying the brands, if you're supplying whoever you are supplying, need to tap into that. And that's where these traceability programs fit in. It's not about the traceability program, it's about the bigger picture, and fitting that narrative and making sure that we are all doing the right thing to enhance the story that the industry can tell. The De Beers Insight Report made which again I can only encourage everyone to read, that they put out in October, or was it beginning of November, or recently, let's say. It tackled 4 areas which it sees shaping the future of the diamond industry. The first being values, as we mentioned, that sustainability story, that those ESG credentials are the values that will underpin value in the industry. And that's very interesting because, you know, when we talk about the value of a diamond, we talk about its rarity that that supports the value of the diamond, and we talk about the emotional side of things, what it represents to the recipient of a diamond. There's that emotional value, but this is bringing a third pillar, and I think it's very interesting, and that's a development that the industry or De Beers is trying to push, the idea that it's the values of the industry, it's the values through which that diamond was recovered and mined, that is bringing added value to the diamond itself. And so it'll be interesting to see how that gets incorporated to the consumer mindset about the industry, and it's a good challenge for us to all have. De Beers also spoke about the rise of brands. Branding is going to be more important and more prevalent in the industry in the future. The future is you know, as long a period as you wish to imagine. I think the point that they made as well is that it's taken shape. It's now. This is what's happening in the industry today, and what's really shaping the industry today. Phygital, which is not my favorite term, but it's really another way to say omni-channel or multi-channel marketing, and multi-channel retail is here to stay. COVID changed the landscape in that sense, brought more prevalence to online sales, but it's also, you know, it's how you combine online, in-store, and importantly, social media interaction is vital is part of that omni-channel play. And finally, they mentioned Web3 and the metaverse. We're seeing sort of trickles of that happening. I think many people are still a bit skeptical of how that is going to play out, but it's a real thing, that's for sure. And De Beers seems pretty confident that the industry has a role to play there, and can find more value in that space. And then so the other editorial theme that we're looking at is marketing, and for so long the industry was crying out for the retail space and for De Beers to up its marketing game, and I really think that we're seeing positive strides in that sense this year. The Natural Diamond Council is doing its thing. People want to see these big sort of sloganed campaigns from the Natural Diamond Council, but I think we do need to acknowledge their focus on content creation and monitor how that is developing and seeping into the consumer mindset. What's kind of cool and exciting for me is the level of brand ambassadors that are now involved in the diamond industry, or with jewelry, or partnering with jewelry companies. I feel like there's been a step up to sort of more A-listers, let's say, that we're seeing. Beyonce was worked with Tiffany and Co. this year. Hailey Bieber is featured in Tiffany's holiday season campaign. Lily James is the brand ambassador for the Natural Diamond Council, and Lupita Nyong'o, which is working with De Beers on its marketing and campaigns, and you see that it's more than just it's more than just an ad, maybe with the exception of Beyonce, but these companies, these organizations are getting these personalities to talk about their diamond experience, taking them to Botswana, taking them around to different mines, and understand the process. And that's a very important thing, that they can spread the message to the consumer. And so before we end, and I'll take some time for questions as well. Before we end, I do want to just touch on the De Beers Botswana relationship with the, which maybe is a bit risque in our world to touch on it, but it's certainly been in the headlines lately. There was a story coming out of the local press in Botswana saying that that the government is looking to forge to change its relationship with De Beers and move to sort of a different model, mentioning the partnership between Lucara and HB Antwerp as an example that it wants to follow. The article was misdirected and clearly not on point, and the government and De Beers put out a statement saying as much. But I think where there is smoke, there's also fire, and I think it's important for us as an industry to understand what's happening there. And so, just in terms of background, De Beers and Botswana have a very intimate relationship. Botswana is a 15% stakeholder in De Beers. Anglo American owns 85%, but more than that, they have joint ventures in other businesses, notably Debswana, which is the mining company or the mining unit of De Beers in Botswana. So they're 50-50 owner% partners in that business, and similarly joint venture partners in DTC Botswana, which is the distribution arm of Botswana Goods. And so they're negotiating. Every 10 years, they renegotiate their sales and marketing agreement, which outlines how they operate in Botswana, essentially. You know, what percentage of goods are going to site holders, what percentage of goods are going to site holders in Botswana, what percentage of goods are being sold by Okavango, or the creation of Okavango. And so the other, but then there's another aspect of it as well. This time around, that they're negotiating the renewal of the mining leases at Debswana, and that's as far as I understand, happens every 25 years, or it's a 25-year lease that they are renegotiating. So it's a big deal, that, and so there's a lot on the table at the moment. The renewal was due in 2020, and because of COVID, it was delayed, and then they delayed it again in 2020 to 2023, I think. And so it begs questions why they have delayed it further, and so that's where the speculation comes in, and we're all speculating on what might be on the table, or what might be holding up those negotiations. In terms of, it's an important agreement. The last time they signed this agreement, it led to De Beers moving its operations, its sales and distribution and aggregation operations to Botswana from London. That's why today you have sites in Gaborone rather than in London, where they historically were. And it also saw the creation of Okavango Diamond Company, which is essentially is entitled to up to 15% of Botswana rough, and sells them by tenders, and it's a government agency essentially. And so what the government wants to do always is to add value to its diamond industry, and that's taken shape in that form in the last deal, where De Beers moved to Botswana and Okavango was created. Previously, it had led to the creation to the supply of diamonds to local manufacturers or manufacturers who have set up factories in Botswana. And so so the government of Botswana wants to raise its beneficiation stakes. Beneficiation means to add value and to add value to its diamond industry. It's a mining country, and so instead of exporting all of the rough diamonds coming out of Botswana to manufacturing centers, the beneficiation program enabled more activity, diamond-related activity to take place in Botswana. So there's now, today we have a manufacturing sector there. There's rough trading through the rough sales that take place by De Beers and Okavango, and there are other tenders that take place there as well today. And then with that brought other services such as banking and grading, etc. And so today you have a more sustainable diamond industry in Botswana. And so now these negotiations are exploring how they can further that program. And the speculation is that the government wants to focus on the larger stones. And so I wouldn't be surprised if there is some that is part of the deal, but I would expect that it wouldn't necessarily affect De Beers' access to large stones. They're not going to give. I would be very surprised if they gave all the large specials to Okavango. What I would maybe expect to see is a change in the way Okavango sells its specials, and maybe that's something that they're thinking about to emulate those sort of Lucara, HB Antwerp type of deals. And so it's an interesting development. It matters to the rest of the industry because as Botswana has become more of a trading or more of a diversified diamond center, how does that affect the rest of the supply? What is the route that diamonds are taking today if there's more manufacturing in Botswana? If an Indian company has a factory in Gaborone and they're manufacturing rough to polished there, they're not going to send the polished back to Mumbai to sort and mix with their other goods in order to supply their clients in America. For example, India has a import duty on polished diamonds, and so they don't want to do that. And so are more diamonds going to be exported direct from Botswana to the United States, to New York, or are they going to Dubai first? And that's where the sorting takes place. And we don't see much polished trading going on in Botswana, but maybe that's something that's going to develop over time. And so, and it's also important from a sustainability, from the industry's sustainability point of view. Botswana is a poster child of the industry's ability to uplift communities and really make a difference in a country that is really well run and impressive. So that's what we're keeping an eye on. I think I've spoken enough for one day. I'm going to take some questions. Thank you for listening and thank you for sticking around over this webinar. If you missed anything or you need to go before I tackle the questions, I don't think there are too many in the Q&A. We will be posting this presentation on rapaport.com, which is where you can find all our coverage of the diamond industry. Feel free to reach out to me as well with my details on the screen. Okay, so let's just have a quick look at some questions. Okay, so I'm just going to read without understanding the question beforehand, so I'll work it out as I go along. Now that the RAP correction is over, Rapaport changed prices last week, reduced prices last week on the RAP list. Now that the RAP correction is over, at least for now, when do you see the next correction if demand doesn't pick up as things don't really look very bright, says this listener. And if RAP doesn't correct and sales don't pick up, what would be the future of the polished prices come, let's say, January 2023? Finally, how long can RAP prices keep on coming down if things continue to stay as they are currently? So the question is framed in an interesting way. to suggest that RAP comes down and the market follows. And as we often stress, we are responding to what's happening in the market. As I mentioned earlier, before Diwali, there was the market was the manufacturing sector was reducing prices, was raising its discounts, and so the Rapaport list had to respond to that. And there was this sort of ongoing concern, and buyers were cautious to buy at those levels because they thought they might go down further. And so it was like a vicious cycle, which I think has maybe slowed a bit. It has calmed, let's say. But it depends on the market, what the RAP list reflects, and so I can't really answer that question. I don't know what's going to happen in terms of the market development. As I say, we can reflect on all those factors that I mentioned today in the webinar, and I'll leave you to make your own assumptions, because I don't have a crystal ball. But we will always respond to what's happening in the market, and if the market continues to decline, if discounts continue to rise, then naturally the Rapaport price list has to respond to that. And so yeah, I'll leave it at that. Why is the reduction of supply from Russia, roughly 1/3 of global supply, not supported diamond prices? Does the price decline since March imply the reduction in demand exceeds the reduction in supply? Well, as I hope I explained earlier, we haven't seen the effect of that reduction in supply from Russia. We know that Russian goods are coming to the markets, are still coming to the market, and it's from what I understand, at fairly competitive prices. They're not selling at a discount. But there is less Russian goods, let's say. It's not that all those Russian goods are off the market. There's less that's being supplied. So I think the question that you phrased at the end there, does it imply that the reduction in demand exceeds the reduction in supply? I think the supply hasn't declined, because we saw strong rough buying in the latter half of 2021 and still at the beginning of 2022, and so we're seeing an overhang of production really from those periods, and that's why you've still got the polished inventory at such high levels, and that combined with the reduction in demand, I think, is having an effect on prices. If you ask me what the more important factor there is, I would say yes, the reduction in demand is maybe more of a factor at play, because supply, I think, will always respond to demand, and so it's the demand that's setting. If there's demand, they'll reduce that inventory, and then we will see the impact, the effect of fewer Russian goods on the market. What is your view on the development of lab-grown diamonds? What has to happen for lab-grown diamond prices to stop falling? How do you think the big natural diamond producers will react? What has to happen for lab-grown diamond? Well, the interesting thing about the lab-grown market, and I'll shout out to Idan again, who's written about this, is that there's a bit of an anomaly at play, because demand is rising, but prices are falling, and as we see so clearly in that market dynamic working in the natural diamond industry, when demand rises, it should support prices, but that's not happening in the lab grown. So what has to happen for lab grown diamond prices to stop falling? I don't know. So, demand is, I think at the moment demand is maybe exceeding supply in the lab grown space. They would need a spike in demand or to reduce supply more. I don't know. The question implies that the lab grown market is operating with with different considerations to the natural diamond market, and it's still in its maturing, it's still in its early stages, and that's something we need to keep in mind as well. So it's a tough question to answer. How do you think the big natural diamond producers will react? Well, I think they're reacting with their marketing, with that sustainability message is partly driven by the a response to lab grown messaging, at least. But I think the best way to do it is just really to focus on your own product and have confidence in the product that you're selling. That's the best way that's the best anecdote, I think. We shouldn't, yeah. How much do you think is the engineered stones of, how much do I think that engineered stones are affecting the market? That's again, I think, referring to lab grown, and yeah, the audience member clarifies lab grown versus natural. I think I've pretty much spent a lot of time on that on this webinar. As I mentioned, it surprised us that it's affected the real growth in lab grown has been on the larger stones rather than the smaller stones, and that would naturally have an impact on the market. Beryl Raff, who's the former CEO of Hellsberg Diamonds, a retailer in the United States, said in a conference in Dubai last year, I think it was, that she was talking about how their lab grown offering has really taken off. And it's and she's I think she said it in these sort of words, that the 2-carat lab grown diamond is the new 1-carat natural, and so that should sound alarm bells for the industry and raise some eyebrows, but clearly it's those larger stones that is gaining traction there, as we saw from the brands from Zales, Pandora, Blue Nile, that are offering, just in the last month, have unveiled new collections in the larger stones. Okay, thank you very much. I'm sorry if I went on a bit long. We're 1 hour and 15 minutes in, and I hope you gained a lot from the discussion. I would love to hear from you if you have any comments, any questions. As I said, my details on the screen. You can reach out to me on social media as well. I'm pretty active on LinkedIn, or I try to be, and I hope you gain some insight that is helpful for your business. That's our aim over here, is to gain some understanding of the market that can calm the waters a bit and allow us to do business, empower us to do business with more confidence. So thanks for joining us. Have a great holiday season, everyone. We'll see you again probably in January or February for the next Diamond Trends webinar. And so I wish you all the success in the coming season. Have a great rest of your day. Bye-bye.